Good afternoon. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for June 25th, 2011. We have a sideways normal market, 46 out of 100 on an annual basis looking at weekly RSI, and 27 out of 100 using the 10-day look back and 10-day NDX, so just slightly above oversold. 1.1% above the 200-day moving average is coded red for weakness and sideways condition. Slope of the 50-day moving average is negative 0.25%, which is red and bearish. ADX 14 is stabilized at 23.9. It's just below a strong trend. It's just not quite a strong trend. And with, as you can see in the southwest corner here, plus DI greater than minus DI, the strength of trend is coming from the bearish price action. ATR percentage of 1.32%, you can see is right at the very high end of normal, a hair away from going into volatile conditions. Looking at the 30-day gap stat, 16 times in the last 2 weeks, 30 days, 16 times. The market has gapped down. 9 of those times it's continued to fail and close lower for an average fail of minus 0.8%. 7 times it's reversed to close higher from the open for 0.55% follow through. 14 times the market's gapped up, and 7 times it's reversed to close lower, and 7 times it's reversed or it's maintained to close higher. In both cases, the follow through has been about 0.4%, so no edge there. Looking at the range stat and SPY, it's still at about 1.44%. That's an average plus 1 standard deviation of intraday move, and that works out to about $1.80 in the SPY. You can see the time series of the 10-day NDX here. It's gone from oversold to overbought to oversold in the last 10 days. Almost a definition of a sideways trader's market. No signals in the overreaction or channeling system. The pivot's at 127.27 and at 80.06 in IWM. This S1 at 79.35 is extremely strong in IWM. The last 2 times it's hit that price level on a decline, there's been an extraordinary amount of buying pressure. So that 79.35 price level is one that I would pay attention to if you're trading the Russells. 10-day max pains, surprisingly populated with some bank and energy companies. So JP Morgan, Bank of America, Boeing, ExxonMobil, and GE. ETF 100, that's in natural gas, oil, the VIX, and blended commodities. So definitely energy sector has been getting punished. Channeling signals in a variety of ETFs and in large caps that I would be paying attention to. I like the additional strength in Alcoa and Valero Energy, a mid-cap oil company that I like. Those are very tradable on an intraday basis. ETF tactical summary, you can see the top 5 max pain range compressions. Only one doji, and that was in oil, so I'd be looking to bracket that one and go in either direction. The oil's been very, very volatile and therefore very tradable. That's why I like using VLO and Devon Energy, DVN, for short-term energy trades. Silver has pulled back to below 33.5. A lot of the speculation's gone out of silver based on volatility, and so that looks like a pretty interesting value play right now. XLE, the energy sector, suffering from weakness in oil prices. Japan and the VIX have been surprising strength leaders here the last week or so. Moving on to the Dow 30, or ETF 30. I was right the first time, Dow 30. Lots of channeling signals, as we saw from the cover page, and the top 5 max pain range compressions. Johnson & Johnson looks to me like a really interesting play here. It's been about the highest quality symbol in the Dow 30, and yet the entire consumer staples sector has been suffering from rotation, and so that may be an opportunity to get in on a really good company at a very attractive price. Lots of suffering here in the technology with Intel and Cisco. I'd contrast that with Microsoft, which has been doing relatively better. And if you take a look at the charts of interest video, you'll see the difference in their charts immediately. Coca-Cola, Kraft, and DuPont, I sort of like those as momentum plays on Monday. They've had good 1 and 3 day performances, and DuPont has been exceptionally good as far back as the beginning of the month. Looking at the frogs, I've added to this chart, and now I'm showing extracts of the daily frog, which is looking at 30 days of standard deviation and average range, and then computing a FQN or frog quality number, and that's simply the average range divided by the standard deviation. And it gives a measure of frogginess. And those that are highlighted in green are ones that in that population, and this is the Dow 30 and the ETF 30, ones that are above average plus 1 standard deviation will get you this green rating. Now what's kind of interesting is if you look at something like the utilities now, so we're looking at daily, weekly, and monthly now. So this is 30 weeklies, ranges, and standard deviations to produce like a weekly frog quality number, and then 30 monthly ranges and standard deviations to give a monthly frog quality number. You have something like utilities, which are exceptionally tradable intraday, but weekly and monthly not so much, because there has been not steady follow-through in in that defensive sector. So something can be very tradable intraday, but without having the kinds of follow-throughs on weeks and months that would keep you interested in them for the longer run. Looking for an example on the other side. Here's EFA is kind of interesting, that on a monthly basis it's up around 3.4 froggish, so it's green, and then not so much on the weekly, and the daily is just kind of an average. So I use this table really to just help me understand the behavior characteristics of my targets, and when I'm shifting between time frames, I don't necessarily think that what's very tradable in one frame may necessarily be tradable in another. You can take a look at Japan, for example. Green on the daily, but weekly has just been horrible because there has not been enough follow-through. Now, part of that is that during the day, EWJ's standard deviation is only 3 cents, and so you don't get much movement during the U.S. market. So that's sort of a special case. Coal, on the other hand, is something that looks like it could work on a swing basis, because you have a green rating on weekly and monthly froggishness, but not really on the daily, although at 3.6 is pretty close. So these are the candidates typically on a daily basis that I'm going to be looking at. I see Alcoa, McDonald's, Chevron, utilities. I'll be all over those, particularly with that sharp sell-off in oil last week. I'm looking for continued volatility once the strategic reserves dry up, and now suddenly nations become net buyers. That's only going to help oil prices go up, and so I expect that to continue to be volatile and directional. Looking at the additional market mosaics, what's interesting here is that the last 5 days prices sort of stabilized here. The regression line has slowed down now. It's actually a little bit better than it was last week this time, when the regression line was below its 10-day moving average. It is now closed and is now slightly higher, and because this is happening 2 standard deviations away from average, this is the first warning that we would have of a state change. Now, that next state change could very easily just be an extended sideways period, and you can already see we got 10 or 12 trading days in a row of just no new lows and no new highs. So that's starting to look sideways, and if it continues that way, we'd see slope continue to go back towards the 0 line or the dotted line. So this is the early warning of a potential state change from downward trending to sideways. If that's the case, then what we would see is the sell-off from 137 in SPY as nothing more than a correction in a bull market. You can see the percent stretch above the 200-day moving average is holding here at 2 standard deviations above. Now it's right on that boundary. It's only 1.5% away from the 200, and so we're kind of at the bottom reaches of the the end of an aging bull. But that could also be a natural place for it to find a resumption. And if you look at the slope, this would be a natural place for it to start to improve and at least to get back to sideways. That would be a normal retracement in this regression channel. So that could easily be a sideways market for the next 2 to 3 weeks. Can make a strong case for why that could happen. So again, I think this favors a tactical traders more than anything, because we're going to see a lot of fake outs buying and selling intraday, which is going to make for volatile days but no overnight follow through. That's sort of a scenario for sideways markets, and keeping your powder dry and emphasizing your intraday techniques. Statistics on intraday for intraday traders, the range stats and holding periods. Kind of a mixed bag here on the 5 days, with about an equal number being above and below the zero line for 5-day percent returns. 30-day quality report in the Dow. I like Bank of America, Microsoft, and Home Depot here as on the basis of they were horrible and now are not so horrible, and the divergence is categorized in the green. Among the ETF 30, what I'm looking at there is natural gas, coal, and agriculture. Agriculture is pretty interesting. I look at last Thursday as a potential washout of the weak hands in what's been a sideways market, and then there was a lot of buying pressure in the ag. So it's late in the season for the grains, but there's definitely some tradability inside that. More gap statistics for the big indexes, and the safe zone channeling from Dr. Alexander Elder's book. You can see basically SPY is just hanging tough in this sideways looking channel, hanging right on the edge of the 200-day moving average essentially, but still within the channel. Pivot points of interest. The U.S. has regained its ascendancy here. You can see the return of strength in the small caps and mid caps. Technology just has not followed through to the same degree, though, and diamonds are doing pretty well as a defensive play. Sell-off in oil and the precious metals have brought them to low levels. Again, I am really starting to get a little bullish on energy, only because that release of oil from the strategic reserves is really a tactical measure. No follow-through really capable there. There's just not enough oil in the reserves. And then the globals are starting to suffer. I think just Greece and Euro bank problems have been in the headlines for so much that that's suffering. Japan, kind of the contrarian position here, continuing to climb. Only gold measurably weaker on Friday. Top 15% winners and losers for reference. And the correlation statistics. Nothing surprising there. On the volatility summary of the indexes, it's interesting to note that Latin America is extremely unvolatile compared to its recent past, as are emerging markets in Japan. And that would normally be interpreted as a sign of potential gains here. And when you look at the charts of interest video, I think you'll see why. So that's a review of the daily trading plan for 25 June. Keep your powder dry and your risk measured.